team members, today being our physical meeting. And before we start our today's meeting, let me confess, after the COVID, it was very difficult for us to predict the number of the participants. And today we have got this ruby hole instead of emerald at upstairs. Hopefully you are you're supportive. So today please bear with us if the participants gets increased, and we'll have to accommodate our all the members with us. So with this, let's start our today's very important topic we have today with us, and a very important speaker also. Before we start our today's meeting, we'll run our all the members to please rise. Yeah. Now run our national anthem. Start our today's sessions. There is one announcement. The active member C. Ajit Singhvi sir. So we'll maintain 30 seconds silence for we'll pray our Almighty for the rest of this departed soul. We also lost our very active and co-group member Sheel Bhanushali. So for him also we'll maintain 30 seconds. This topic, as we all aware, that the Ministry of Corporate Affairs has amended the Schedule 3 of the Companies Act to increase the transparency and some more good disclosures in the audit report also. And parallelly, there are some changes in the CARO. Most of the changes are similar. So we thought let's start with this very important topic, and we are very much fortunate today. We having with us the past chairman WIC Shriniwas Joshi sir and past Central Council member. So now today's legend speaker, I would like to invite our immediate past convener Shri Krishna Kumar sir. Please Krishna Kumar sir, if you can introduce.
Thank you, convener, for this opportunity. So, I had given the task to introduce today's learned speaker, Sri Shriniwas Joshi. So, Shriniwas Joshi is the partner in CBK Associates, and he is in practice for more than 42 years. By qualification, he is a chartered accountant and company secretary, and he is the elected member of Central Council for 2 terms, that is 2013 to 16 and 2019 to 22. He was the chairman of WRC of ICI during the year 2011-12, and he was 3-term regional council member 2004 to 7, 7 to 10, and 10 to 13. During his tenure as Central Council member, he had different responsibility undertaken. He was the chairman of Financial Reporting Review Board during 2019-20, chairman of PDC Committee 2020-21. He was the chairman of Corporate Laws and Corporate Governance Committee 21-22. He was the convener UDIN Directorate 2021-22. He was the vice chairman, convener, and deputy convener of Audit and Assurance Standard Board during 2014-15 and 2021-22, and Audit Committee 2020-21, and Center for Quality Audit Quality. He was also member of 29 committees out of approximately 40 committees of ICI and 3 directorate of council for 2021-22, including Auditing Standard Board, Committee of Members in Industry and Business, Committee for Members in Practice, Editorial Board, Ethical Standard Board, Expert Advisory Committee, Taxation Quality Review Board, Financial Reporting Review Board, Internal Audit Standard Board, and Professional Development Committee. He was also the member in committee of NPOs and cooperative sectors in South Asian Federation of Accountants, that is SAFA. He was also member of groups such as Committee for Review, Education and Training, Specification of Companies Act and LLP Act, Review of Articleship Training, issues relating to chapters and representative office of ICI, standard of audit of smaller and less complex ethics. He was also the convener of revision publications on mutual fund, accounting for software, guidance note, schedule 3, and guidance note on audit of banks. So the same topic we are going to hear from him. On the social front, he was the president of Rotary Club of Mumbai Mulund East in Rotary for the year 2012-13. So with this brief introduction, I present before you today's learned speaker and Sri Shriniwas Joshi. What is yours now, sir?
So before the Srinivas Joshi sir take it further, the bouquet, I would like to invite our founder member in the past present the memento and bouquet to our learned speaker.
बंद कर स्टॉप शेयरिंग कर दे स्टॉप शेयरिंग कर हाँ शेयर कर मुझे
दूसरा Hello. Good morning to all. Can you listen, all of you, up to end? Yeah. Some of you can come in front. Front seats as usual vacant. You who will ask me question, not the other way around. So you can sit here. Friends, today's topic is extremely relevant to all of us, who are all of us are small practitioners. But the subject is like this, that we have schedule 3, division 1, division 2, and division 3. You are aware that division 1 is where accounting standards apply. Yes. Division 2 of schedule 3 is the format of balance sheet and profit and loss account where the Ind AS apply. And division 3 is the format of balance sheet, profit and loss account, and other information relating to NBFCs. And then we have another subject today, CARO 2020. So I thank JB Nagar Study Circle, one of the most vibrant study circle, not of the Western region, but of the whole country, to have taken it up so early. I was thinking that we should start talking about this somewhere around July or maybe after July, when we really start the audits. So maybe we'll need an update by that date. One of the information to you that CARO 2020 guidance note, which was published in June 20, is being revised to sync with schedule 3. Segregate the topic. We have 2 speakers because as per institute regulation, for a 4-hour sessions, you cannot have single speaker. So what I have decided that I'll take up division 1 and CARO relating to division 1. Yagnesh will take up division 2 and 3 and CARO relating to that, wherever there is a reference. But as the convener rightly said that many of the provisions, first is between division 1, 2, 3, there are similar informations required, which I'll take up, which are common to all 3. And in CARO also, there are similar provisions where auditor has to comment. So what we'll do is that in addition to this segregation, where there is hardly any comment to be done for audit, I'll cover it in schedule 3 PPT itself. And when we go to CARO PPT, we will not take up those items again. So with this segregation, we'll start. Yagnesh will come, I hope, anytime, and be a part of this maybe after break. Let us start with the subject. So friends, as you know that there is an original notification of MCA dated 24th March 21. This notification tells us about what are the additional disclosures required in Schedule 3. If you really want to talk on the whole Schedule 3, the whole day may not be enough. What I have done today is only will talk on the amendments or the changes. Now, why this was at all necessary? If you really see, there were two reasons. One is CARO 2020, which was given so early in March itself. Now there we found that it is not in sync with Schedule 3. So fortunately or unfortunately, due to Corona, it got postponed. And now Schedule 3 is sync with that. Actually, it should have been the other way around. First management says something and then auditor comments on that. It is the other way around. First we were asked to comment and now Schedule 3 is syncing. But actually, if you really see, it was necessary to reduce the expectation gap. The government, or why the government, even all other stakeholders feel auditor should be more independent, should be more independent, should be more more, giving more to the readers, and we are not doing it. Probably to meet that expectation gap, now we have been mandated by in Schedule 3, management has been mandated to give something, and in CARO we have been mandated to comment on something. Since now Yagnesh is here, let us welcome him. Thank you, sir. And I already told Yagnesh about the segregation of duties, but I didn't tell them why you are the second speaker, which I'll tell you when you come. One is Yagnesh is a public speaker and I am a technical speaker. There is a huge difference between two. If the technical speaker is later, after public speaker, half of you will go. So if Yagnesh you listen to first before me, it's danger. So I told him, please, please speak after me, because you know him as a very good public speaker. Secondly, I hardly know anything about Ind-AS, which he gives lecture to Big Four also on Ind-AS. So maybe a right person to talk on Ind-AS and related CARO. Third thing is that, and every reason is more important. Huh? Third thing is he is already, knowledgeable, intelligent, good looking. So keeping good company helps. So I told him that, yes, you be with me. And probably the last and the best thing why I asked him to be here is, he said, you can go away, I'll handle those sota queries. I'll handle everything at the end. Don't worry. So I thought better that I put him there and I'm out of it. Anyway, so just to say that I'm there for the full time, no issue. So coming to this, why we were saying is that this is to reduce the expectation gap. Second, there are many reasons why government introduced this. One is to improve the corporate governance. Friends, if you see what is the corporate governance, we talk so much about corporate governance. Corporate governance is aims at independent and objective decisions by the board. If you really see what we are looking at, independent and objective decisions of the board, transparency in procedures and practices, and appropriate monitoring in the functioning of management team. If these three objectives were there in a governance, then if you see several things that are there in Schedule 3, if you see the promoters holding loans to related parties without mentioning terms, or CWIP continuing for a long time, aging is to be given, so you know, but title deeds not in the name, and so many of them tell us about how the company is being run and whether it is right for a company to run like that. So whether corporate governance is at high standard or not, we'll know. Second reason is auditors' responsibility. They wanted to improve, and improving the auditor's responsibility is obvious. Is obvious that we have the trade payable, receivable aging now very in detailed. We have inventories. We have to say whether they tally or match every quarter with the statement submitted, or if we have the utilization of borrowed funds, of which we'll talk. So all these indicate that our responsibilities have substantially increased. They wanted to do that. And third is the transparency in disclosures. Now, one thing is that this transparency, the government wanted management to be responsible. Now, if you see that the management gives a aging of CWIP, they will have to explain as to why the project is pending for a long time. In all these years, we are having one figure in the balance sheet, even without aging, without details, which projects are on, how many projects are on, nothing was there. Now, to give that details, many questions can come in AGM. What is happening even from auditors, many questions would come. We should have asked. Remember the expectation gap. We should have asked and reported. We did not do that. That's why these provisions have come in the act itself now. Now coming to, you can have the, for example, one side you see improved current ratio, and the companies give several ratios on their own. And you don't know that improved current ratio has come from increase aging in debtors. Now this thing can be linked. If you see the way now Schedule 3 is designed, it's designed to give you appropriate information to the reader as to, and to link various things. So something looks good, looks bright, but it's not. So, or the other way around. Now, that is how it will be. Now, I say that it will improve the independence of auditors. Now, you know, if I ask questions, I'm afraid that the client may not like. But if government asks question, client, I can always say, that is not mine. This is the question asked by government, I must reply. And this is where my independence will increase, because I am now empowered. I am empowered by the government to ask certain questions and report on that. And therefore, I feel that this is a right move to make us more independent. We can ask for information. We have a now right to ask several of the information. If you see several of these new clauses, this was to be actually reported by us, should have been, but we have not because of many reasons. And I feel empowered and independent on this. Another thing is we'll have a substantial discipline. Now, discipline is of two types. One is there is an operating management discipline. Now, since many things will be revealed, the management will have to be more disciplined in its working. So it's not only violation of company law, which is apparent, the non-governance will also be apparent, or misgovernance will also be apparent, if you really see. And therefore, this is where we are. Friends, there is a comment that with this kind of information given in Schedule 3 and CARO, instead of true and fair view, we are going for proprietary audit. Now, proprietary audit is something that is, we are now challenging indirectly or directly whether management is right or not. When you are revealing some information and then commenting on that, it's obvious that I am challenging the decisions. I am putting myself in the shoes of the management. Now, even the logic behind such decisions will have to be challenged by the auditor. This is what we mean by proprietary audit. Now, for example, if there is a cost escalation in CWIP or delay in the projects, once management sets it, auditor will also have to look into it. So if you see, they will have to explain about these projects, which they were not in the past. They will have to, suppose title deeds are not in the name of the company. They will have to explain why. There is a reason to be given by them. So if you see that this is a proprietary audit, you are saying why it is not in the name of the company, even though it was asked in the past also, but something similar. Transfer of CSR funds, suppose it is done to their own trust, and your own trust doesn't spend. Now they will have to explain why there is nothing. Now, all these questions on CSR, if you see, in schedule 3 or CARO, you will find that this is to be given. So it has become a proprietary audit. Now, futuristic projections, the audit was always on the past data all these years. But if you see CWIP, it is asking the expected date of completion of the projects. Now you are signing that balance sheet. We are signing the balance sheet. So this futuristic projection also need to be looked into by the auditor. So far, we were looking only one futuristic projection. That is SA 570 going concern. That going concern, whether company will be going concern in next 12 months. Only one futuristic projection. Yes, I say, in my opinion, it will survive for next 12 months. There is a question on that, we'll deal with that. But with that kind of projection, now this is the second one that has come, whether CWIP, whether the projects would get completed. And when management, when you are sure that the project may not get completed with whatever assumptions they have made, you may have to comment. Now, this is where futuristic projections have come in. Now, this is obviously substantial additional work, risk and responsibility. We therefore, to save our certificate, I will say that we should never be under pressure from now onwards. We can ask not only the questions that are there in this schedule 3 or CARO, we should ask any question that we like. Now we are more empowered by the government to do that. We must put our foot down and say, I need this if you want a report. Otherwise, accept my qualified report or disclaimer, SA 706, or you accept that it is not true and fair. So we are more empowered. But the last thing I like to say is, many have commented after this schedule 3 and CARO that there is a tremendous information overload. If you really see, when I was last year CLCGC chairman, corporate law, there is a move by the government to go for a long form audit report, like in case of banks, in case of companies, they want LFR. I argued that either you can have CARO or LFR. You can't have both because both will have similar information. You can have LFR, which will be much, it's nothing but an internal control questionnaire. If you see in bank audit, and I have come here several times to speak on bank audit, company law, and also you have heard me many times on that. So this is, then if you have, either you will have more and more questions in CARO for auditors to answer, or you will have long form audit report for the companies. Now, LFR in case of banks is given after 1 month, almost 1.5 months after the audit is signed. Whether similar thing will happen in companies or we have to give it simultaneously will be a question. But anyway, there is an information overload already, and we will have to put it up with that. Now, see what the schedule 3, the general guidance is about schedule 3 given by the government. They say that requirement of Companies Act and notified accounting standards would prevail. Now you will say this is obvious because Companies Act is the original act, accounting standard and now even auditing standards are part of the Companies Act. And therefore, obviously, when you are saying schedule 3 is a schedule, so obviously act and what is stated in the act, section 133 on accounting standard would prevail. But it is not as easy. Sometimes there can be something asked in schedule 3 which may not sync with accounting standards. Example is given in the guidance notes also. The example is that this is, you can see AS3 on cash flow. Now cash flow says that cash and cash equivalent will be a fixed deposit of 3 months, only up to 3 months, cash and cash equivalent. But the heading says cash and cash equivalent. Actually, everything is not cash and cash equivalent as per AS3. So suppose FD is kept for against security against guarantees given or LCs is not a part of cash and cash equivalent, right? So FDs which are long term are not cash and cash equivalent. There can be many items which are bank balances but not cash and cash equivalent. Now, if there are restrictions in say transfers, international transfers, there's a restriction. So it is not cash and cash equivalent. So what we'll have to modify in such cases, this first line looks very simple, but what we have to do is you write on the top cash and bank balance, in that A, cash and cash equivalents, and B, other balances, and give balances of which are not in the nature of cash and cash equivalent as per AS3 into that. So these are type of modifications that are expected because the Act and accounting standard would prevail over Schedule 3. Also know that there is additional information required in several standards. Say AS18 will require a lot of information on related parties. AS15 will require a lot of information about the gratuity and other benefits that we offer, employee benefits. AS19 will ask us to give a lot of information on leases. Just to give you some examples. Now this will be in addition to what is Schedule 3. So all that we'll have to understand. One is that they would prevail, and second is this information would added. That's why I'm saying there is information overload. The size of the accounts will increase. Disclosure requirement under other acts also are important. First of all, under Companies Act itself, there are other disclosures which are not there in Schedule 3. For example, Section 182 talks of donation to political parties. That disclosure is not given today in Schedule 3. Now, that is company law itself. But if you see other act, MSME Act asks us to give more information. Several guidance notes of institute ask us to give information in a particular format. So all that is loaded here. In addition, what you will be listening. Now, terms used in Schedule 3 shall have a meaning as defining applicable accounting standards. Now they have not defined everything in that document. They say you read accounting standard. Now accounting standard, you know what is associate, what is related party, etc., etc. You read the respective accounting standard to know that. Coming to other things, other aspects about this, these disclosure requirement, friends, are absolutely minimum. Now here, always add something to that if you feel that will make the reader more enriched about what we are giving. But this, what they say, has to be given. Now, therefore, I personally felt the last line, if you see, what is not applicable, suppose there is a format, it's a new company, many of the heads are not applicable. I'm talking of main heads, not subheads. Now, if the main heads is not applicable, I would make a balance sheet giving the main heads, write whatever is applicable and sign. But when I presented this guidance note, division 1, division 2, division 3 to the council in the February, almost last meeting, I presented that because we were trying this for 6 months. We are ready in September. And when I presented, the council members felt that it is not necessary. Because Schedule 3 by itself doesn't say all heads need to be actually given there. So this is suppose a new company formed on 27th of March. It only has capital, share capital and bank balance. That is enough. That is the opinion of the council. So in the guidance note, we have written that this is not necessary. But in my opinion, whenever we used to make for olden days, I remember we used to at least give main heads, capital reserve, like this main heads. So just decide yourself, but guidance note says not applicable. I said that in my opinion, but guidance note said it's not required. Otherwise, that is why what I call a minimum requirement. Minimum requirement should be the first format anyway. For better understanding of the financial position, the Schedule 3 allows us to give more line items, sub-items, subtotals, etc. Now you will say, what is this provision exactly? Why they have not themselves given? They say that if it is relevant to the reader, you can modify. Modify means give additionally. You can have an example, like suppose many of the analysts of the balance sheet would like to know earning before interest, taxes, depreciation and amortization. So you your profit loss account, you can have that earning separately added, separately totaled and shown. This is the meaning of this. That, for example, if you want reader to know about current ratio, you can have total of current asset and current liability, or a liquid ratio, you can have a related totals made. This is not a part otherwise of the Schedule 3 format. So this line indicates why I'm explaining. These are all general things they have stated at the beginning. So I'm giving example why this is stated and how it is to be used in actual practice. Now next is unit of measurement should be uniform and rounding off it prescribed. Actually, it is not prescribed. You will have to do rounding off now onwards. There is no rupee paise now onwards. We will have to round off. What is the rounding off provision that is stated there? If the turnover is less than 100 crores, then round off to nearest 100, nearest 1000, nearest lakh, or nearest million. And if it is more than 100 crores, round off to nearest lakh, nearest million, or nearest crores. So what happens is that if you have more than 100 crore, it will be in lakhs only, but decimals are allowed. Means lakhs and 2 decimals, or crores and 2 decimals if you feel like. So rounding off doesn't mean rupee rounding off, where we round off in rupees normally. Now we'll round off to minimum in 100 and point. Now we'll go to guidance note per se. I told you there are 3 divisions. CLCGC, we had groups. Actually, these guidance notes were issued in 19 first, and we revised that. So I thought that I made the same group work. There are a lot of partners of large firms in that who did this. I was chairman that time, and so I was in all the groups. And I, as I say, presented it to council, presented it to our own CLCGC board and all. Coming to covers, what these guidance note do? Very consciously, if you see the guidance note and CARO 20 guidance note, CARO 20 guidance note is issued by AASB, Auditing and Assurance Standard Board. And this is issued by Corporate Law Committee. Corporate Law Committee, while I'm cautioning you when you read the guidance note, why I'm saying is this guidance note gives only disclosure guidance. It doesn't give, consciously doesn't give any guidance on audit. It doesn't give. It says this is the guidance note for preparers, and we should know what is the guidance to preparers. So that is why we are reading this. Unless we know what preparer is doing, I can't audit. So this is the guidance note actually for preparers. That is one thing you should understand. There is no interpretation of any law like income tax, GST, nothing in the guidance note, or there is no interpretation of accounting standard or Ind AS in the guidance note. This is purely disclosure guidance note. How to disclose each of the item, what are the additional things you will have to look into before disclosing it appropriately. There, the guidance is based on that. This is fully aligned to CARO 2020, as CARO 2020 came first, and many of the items, as it was stated, are common. Now, only conceptual guidance is given. There is no rule-based guidance in the whole guidance note. It is purely conceptual. What happens with conceptual guidance? You will have to listen to Yagnesh Desai repeatedly, because Ind AS says only conceptual guidance, no rule-based guidance. Now, what happens in the conceptual guidance? You will have to think. You will have to make judgments. Very difficult. Why should I do it? Give me the solution. Give me what is to be written. I'll write and go away. That is not possible here. Our guidance note still talks of conceptual guidance. It requires a lot of judgment on the part of auditor. The guidance note says materiality, talks of materiality. Actually, if you see, asking government to put material, there is no materiality concept in schedule. If you really see the whole schedule 3, nowhere the word materiality has been used. But our guidance note says, for God's sake, use materiality. What you have to show and not to show here should be logically thought of. So use materiality. Guidance note proposes that balance be maintained in providing excessive details against too much aggregation. Now here, why it is so? Excessive information is excessive information overload, as I say, and reader will understand nothing. But if you aggregate many things also, like we were doing in CWIP, one single figure, crore, hundreds of crore or thousands of crore, one single figure, which was giving no information. So too much aggregation also is difficult, but too much, giving too much data is also difficult. So they say, as a preparer, one must have the balance between the two, so as not to obscure the important information. So actually, your aggregating, but where important information needs to be given, you don't aggregate, obviously, and you give separate information. Now, why I am talking of clarification issued by ICI regarding authority attached and recommendatory nature of guidance note. Friends, when you very inconvenient to follow that in many places, either CARO guidance note or division 2 guidance notes. So you will feel jane do nahi karta hu because it is recommendatory. That's why I deliberately am reading a para from the institute book which says what is the authority to the various publications of the institute. Let us listen carefully and then we'll never say guidance notes are to be followed. It's recommendatory and may not be followed. Let us read that. Guidance notes are primarily designed to provide guidance to members on matters which may arise in the course of their professional work and on which they may desire assistance in resolving issues which may pose difficulty. This is the basic reason why guidance notes are issued. Guidance notes are recommendatory in nature. A member should ordinarily follow recommendations in guidance note relating to now there are two types of guidance note, auditing guidance note and accounting guidance note. So there are two separate paragraphs. The member should ordinarily follow recommendation in a guidance note relating to an auditing matter, except when he is satisfied that in the circumstances of the case, it may not be necessary to do so. This is auditing. Similarly, while discharging his attest function, a member should examine whether the recommendation in a guidance note relating to an accounting matter have been followed or not. If the same has not been followed, the member should consider whether keeping in view the circumstances of the case, a disclosure in the report is necessary. So here is an additional risk and responsibility that if it is not followed, I have a judgment whether I need to comment on that. In the first case, in case of auditing, they say you decide whether you want to audit in this fashion or you want to audit differently. Here, there is almost no option. You say you have decided not to comment, then you'll have to write, you'll have to document why it is done. That is the authority. Guidance on matters, so virtually we'll have to follow. Guidance on matters which may arise. Documentation required, why guidance note is not necessary. If the financial statement prepared without following guidance note, disclose what is necessary. We have already said this. There are several guidance notes which are listed or referred in the guidance note on schedule. This is not a full list. Some of the guidance note I said, the revaluation reserve, employee share-based payment, minimum alternate tax, rate regulator activity, derivative contract. What the writers of guidance notes have thought, if that this is also included in the guidance note, it will become too big. So instead of that, they say read this in this particular para to give reply, read that particular guidance note. And everything should go. For example, CSR, they'll say CSR guidance note is already available. So go there. So instead of, again putting it as an annexure or something, then it would have been very big. Already there are 3 divisions, 3 different books. So to avoid that, this has been done. Now here, additional disclosures are there. Now, I have already here, it's also, I think I have given lecture on CARO, for example, in CARO 16 or Schedule 3. Now coming to this, we will talk only of few additional disclosures. There are many additional disclosures, but if you see the guidance note, the way it is written, there is no value addition to what the question is. If the question is very, very straightforward, it doesn't require any judgment, it doesn't require any additional information, knowledge, then what has happened is, there's no need to discuss. You can just read the question and answer. So I've selected some of the question where actually the guidance notes give much, much more detailed explanation of what it is and why it is. Then, as I say, you give me liberty of adding some auditing issues here so that when we talk of CARO 2020 also, those things need not be considered for small things. Now, shareholding of promoters, it is to be given in very detailed format. Now, what is to be done? First, it has to be given for each class. So shareholding of the promoter in equity, again in different types of equity, only for equity with having right only of dividend or whatever, or restricted right to vote, all types of shares you will have to give promoters to. Second is we have to give percentage change during the year over opening balance. So what was the opening balance of the year? Or if it's a new company, if the shares are issued for the first time in the year, from that date to last date, what is the percentage difference? You don't have to give stage wise, the first date and the last date. So first date can be for new company somewhere in between, otherwise the first date of the year. What you have to give? Number of shares, the value of shares, and total change for the end of the year. Now, why this provision has come? You understand the importance. What is this? Most of us who do private limited, there will be no change. It is not regarding that. Again, this is not talking of splitting of shares from 100 to 10. It's only percentage. So I have so many shares. So, but if it is splitting into value different, I think we'll have to write it properly. But here, why this provision has come? Everything in Schedule 3 has come for two reasons. One is either management was not ready to give some information to the shareholder, or auditor was silent. To show that CARO is changed and Schedule 3 is changed. For Schedule 3 is changed, for management must give information on something, and CARO is changed to say if that information needs auditing, then CARO has a question. Now here coming to this, lot of owners have placed the shares in the bank and got money to be used outside the business, not the business for which they are holding the shares. One of the recent example is Eveready. I hope you have heard that Burmans of Dabur Group are trying to take over Eveready. Eveready has more, still even today, it's not doing well for some years, still has more than 50% share of the market, Indian market, Eveready. That company, 2 years back, Khaitans were owning 44% in this company. Today, they own only 4.8%. Why? Because they have placed the shares of McLeod Russell and Eveready for their loans against McNeil Bharat Engineering, which was a group company. They could not repay that. So banks started, consortium started selling some shares. Now it is reduced to 4.8%. So Burmans could go to market, increase their shareholding from 18% to 25%, has now given a public offer for balance as per SEBI rules. So this percentage of the shareholding of a promoter has very significant reading. If you see SA 570 on going concern, one of the item you have to see whether promoter has pledged the share or promoter has shares have been reducing. So his interest in the company is reducing, has a cause of concern. It can have severe implications on the governance. It can have severe implication on internal controls. He is not interested now, or more others may be interested. So what will happen to company? This is why this particular clause is introduced. Otherwise, you will feel this is very innocuous. But if it is happening, it may have audit implication if you feel that management is disinterested. If once it gets disinterested, it can become corrupt also. It can, because you see, it has nothing to do with growing this company. Now, friends, again, the guidance note reminds us that trade payable here in trade payable, trade receivable, you are aware that trade payable is only for purchase of goods and services. No contractual obligation. There are two items in Schedule 3, trade payables and others. Contractual obligations such as statutory payments, that is all TDA, GST, etc., which are in balance sheet, purchase of property. So you have a liability in a sense, or you have reimbursable expenses or interest accrued on trade payable. Even interest on trade payable is not a trade payable. It's a contractual obligation. So all that will come in others. This is what the trade payable is saying. And trade payable due to MSME has to be segregated. All the time we have given information on MSME, but here it says in the format itself, now you say how much is due to MSME. Otherwise, we were giving either the information that company has not done anything about finding out how many MSMEs are there as a supplier. Mainly, I think 99% of private limited balance sheets will have this comment that they have not identified. Now you have to give a separate figure. You can't say nil. If you say nil, You have to again write asterisk, information not available. So now see the what I am talking of governance. Governance will improve. They will have to find out because they have to give a separate figure now, payable, receivable. So now due to MSME has to be separated. Now coming to this, what about this trade payable? We have to give aging schedule. So trade payable never had an aging schedule. You say why it is required. Let us see why it is required. First, let us understand what is aging. Aging is required less than 1 year. This is different for trade receivable. We'll go for that. Here it is less than 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. Aging. And you know, the guidance note in both the places, in trade receivable and trade payable says, and in various clauses, they say, the figure of total must tally to balance sheet. I mean, where the chartered accountants don't look even at that. I'm surprised when it says that if you are giving such kind of additional information, the summary should match there, or there cannot be others, you know, trade payable in this aging and total, more than 3 years total. So there's nothing like others, unreconciled and nothing. So you say that total should tally. Why chartered accountant need to be told about this is because we are callous. We are not serious. We are signing, we get audit on 27th November, accept and still sign on 30th November. And that is where we don't have time to go through this. So, chalta hai, abhi nahi chalega. If no due dates of payment, now for aging, you will need a due date of payment. The aging will go by due date of payment. So 1 year delay, less than 1 year or 1 year to 2 years is a delay. So from the date it should have been paid. If you don't know the date of transaction. From that the aging can be done. Now institute has recommended 2 more columns which are not there in the original schedule 3. One column is unbilled liabilities. Now unbilled liabilities is where you are trying to finalize fast. Many of the companies finalize in first week of April. So they may not receive bills. So unbilled liabilities, number 1, and amounts not due but provided for. Not due means not due for payment. Example is say debenture interest to be paid in June 30th and December end. So March will provide 3 months, which is not due. Liability but not due. So liability but not due has to be segregated. Why? Because it does not enter the ratio calculation. Because it is not due. Remember why institute says something, they have explained also. Read guidance note line by line, then we will get a lot of information why. Once you know why, we'll never forget. So there are 2 things, unbilled liabilities and not due. As an additional line items, you say. They are given all formats also how to present it properly. Now they say that not only MSME dues are to be segregated, the Schedule 3 requires us to say disputed dues. So disputed MSME dues and disputed other than MSME dues. So disputed dues have to be segregated. Now what is the dispute? So the guidance note tells us that the dispute is as defined in IBC code. Now Insolvency and Bankruptcy Code, section 5 subsection 6 says, dispute includes suit or arbitration proceedings relating to existence of amount of debt, quality of goods or services, the breach of a warranty or representation. Now, institute has given one more definition of dispute. Dispute means disagreement between 2 parties demonstrated by some positive evidence which supports or corroborates the fact of disagreement. Now, friends, dispute cannot be in that case verbal or oral, that I fight with you and there is nothing on the record that I fight with you. It is not. Dispute has to be evidence and it is supported or corroborated by facts which are documented by auditor. So even documented by the company. So what here we'll have to do? If company says dispute, we'll have to ask for correspondence, emails, whatever, evidencing that there is a dispute. Otherwise, it will not go in disputed column. Friends, dispute has a problem because dispute can be 2 types. One is dispute is I will not pay you this because quality is not good. So your liability is overstated. And dispute can be other way around. He is asking more. I have put only 5 crore as my liability. He says give me 7 crore. Because this is what I supplied and this is. So dispute, so bill is 7 crore. I entered for 5 crore. Now the dispute can be you pay me 7 crore. with interest is a dispute. And it can be other way around also. As I say, I booked 7 crore, but I'm disputing saying 5 crore is payable. Now both have audit implication. When you say disputed, first see that there is a correspondence, there is an evidence, corroborative evidence, and also see that it is considered in your audit. So this is where the dispute definition will help you. Even though they say IBC code, this disagreement between parties demonstrated by positive evidence is something I think we should look at. Now let us go to CWIP. Now there are, as I told you, capital work in progress was always a single figure with which was so giving no information to the reader as to what's happening in company. Many times capital work in progress was used, the head was used to capitalize the expenditure which will never be finally capitalized. Means you just transfer the expenditure to show more profit. When you actually capitalize, put it back to P&L whenever possible and capitalize only the balance. I mean, in the 4 corner, we can always say this, even though this is recorded, I think only for internal purpose, but such things could have happened or may have happened. Now to stop that, the capital work in progress has come as a detailed disclosure in capital work in progress. So what is the first disclosure we are supposed to give? Projects in progress and projects temporarily suspended with aging. So let us first understand what is temporary suspension. Project in progress, all of us know. And aging is to be done less than 1 year, 1 to 2 years, 2 to 3 years, more than 3 years, and total. And total should tally to balance sheet figure. Now coming to this, again in aging, I have to give projects in progress and projects temporarily suspended. There are various ESC opinions. Expert advisory committee. I was in expert advisory committee also several years. There are a lot of discussion on what is temporary suspension. I'm not going into all of that. You can read ESC opinions on your own. It's very interesting. Some people feel accounting is static. It's not. See what internationally people think of each of those problems and how they really react to it, how they think about it, how they present it, and how they feel this is right way of presentation. What is temporary suspension? We should know what is temporary suspension. It is not a the project has stopped. Suppose the building has been constructed fully usable condition, but it's not put to use because the local municipality has still to give you the license to use that. Okay, so that has not come. Now this type of stopping of a project is necessary to complete the project. To hand over that project to the persons who have bought commercial or residential premises, I need to stop. Many times while constructing roads, constructing dams, constructing various shipyards, etc., you may need permissions of various authorities. You may need permission in case of a company having manufacturing pollution control board, which after everything is set in motion, they will have to come verify that pollution emission is appropriately controlled by you and then give you permission to start your company. So this kind of stoppages is not temporary suspension, where it is absolutely required to complete the project. It's a part of the project, you know, the timeline, that this timeline separately 2 months are kept for this permission in the whole timeline of the project. When that is there, that is done, it is not a temporary suspension. So you have to see what is a temporary suspension. It should be really temporarily suspended for reasons other than when it is required. So in case of COVID, it was not required. COVID is not something that was planned. So in any case, it becomes a suspension. Otherwise, and remember this difference, why it is made. When project is temporarily suspended, interest cannot be capitalized. This is very serious. I mean, when you segregate something like this, it has implication in accounting. Don't think that government has given anything line items without thinking why it is so. There are reasons why these things are given. So before putting anything in temporary suspension, think of other effects of that. Coming to project-wise details are required. So even inside that, projects in progress, I must give 10 projects in progress. Now what, suppose 5 or 10 are in progress. And I have to give the aging. Now what happens is it immediately reveals that some projects which are shown in progress have actually stopped. Stopped, not suspended, stopped. For example, out of these 5 or 10 projects, some projects are showing the expenditure made 3 years back and nothing in the current period. Something made 5 years back, nothing in the current period. What it indicates? Auditor has to also ask here that why this is still appearing in CWIP. Why project was not completed? How much more expenditure is expected on that? Whether this project will ever see the light of the day or whether it should be written off. Serious, right? One, temporary is serious. Second is aging is serious. Moment you give aging project wise, there are many questions for project in progress also. When you see project in progress, there is a original estimation of that project and it was to be completed by a time. Now you will have to see, of course, I say that investment properties are also part of this. Aggregation of the projects are also allowed. Means you need not give all 10 projects. If they are not material, say all other projects are total 10% of CWIP, you decide materiality. You add up, aggregate those and give only material projects on the top. But aging will be required for others. So if others, you are aggregating and different aging, but then you have to put it in proper slots. There are issues relating to project temporarily suspended during the year, but resumed either during the same year. So if the project is suspended in May and resumed say in October, at the end of the year, it is project in progress. So we are giving the position as on the date of balance sheet. So it will be project in progress. Now, if it is suspended temporarily and revived after the end of the year, it is still project in temporary suspension. It is not a project in progress. You have to see the position as on 31st March. And secondly, you remember that when you are giving comparatives, we'll talk on comparatives later, but when we are giving balance sheet of 22, we have to give also figures of 21. So all these data also will be required for 21. Now you will say, suppose project was in suspension in end of 21, but 22 end it is project in progress. Whether previous year should be changed? No. Previous year will remain as it is for the same project. It was in suspension. It has started now or the other way. So it was in progress, but now it is suspended. So just see that the previous year is not changed, but otherwise this is a serious issue. Now there are two things to be given in projects. As an auditor also, I'm really worried how we do that, because two things. One is overdue period. So project wise, when it should have been completed, how much it is overdue in timeline. And second is cost wise. Project is within time, but there is a cost overrun already over the plan. Now the thing is that there are two things. What is the update? There is an update of estimation and assumptions time to time when the project is on. This is not the revised plan. You have to distinguish between the original plan and a revised plan. Now, what is an original plan? Original plan shall be considered as that plan which is approved by the relevant approving authority and on the basis of which the implementation of the project is evaluated. This is what is the definition of original plan. Approved by relevant. A relevant authority can be even board of directors. It's not necessary that any government authority, but most of the time government authority will be there approving the plan. Now, what is the revised plan? Revision due to change in management estimate and assumption with respect to future businesses, development in economy or industry or regulatory requirement. Now, what is the judgment of the auditor, judge or the accountant who is doing this segregation between because you have to stick to original plan and give two things. One is cost overrun, another is time overrun. So if it is a revised plan, it should be in such a situation that it becomes original plan. Then only I can use revised plan for this kind of aging that is required. Now, what is the judgment required? The guidance note says, whether such a revision in plan are in the nature of fresh original plan or simply an update of estimate and assumption such that the original plan is just revisited and restated. If that is so, I will have to go by the dates and cost of the original plan and not that. Now, this data obviously has to be given even for an intangible asset internally developed. So that is project in progress. Why again this kind of provisions come? Why intangible asset? First of all, very few companies will have capitalization of intangible asset internally generated. Many of the IT companies, for example, may have it. Many of the pharmaceutical companies which are may have such kind of CWIP, which will be capitalized as an intangible asset at the end of that particular cycle or completion of the work. Now here again, there, suppose the pharmaceutical company or IT company was having a project and it got actually shared, it will show in project in progress, no expenditure for last 2 years. That means project is shared. It is not, will not see the light of the day. So you will have to see that this kind of intangibles also may require a write-off. So here, when intangible also is done in CWIP, it will be necessary. Now, receivable, everyone is concerned about receivable. Now, one is we must understand what is to be given in receivable. Lot of things are required to be given in receivables now. Previously we say what is debtors, and commonly called debtors is receivable. Nothing else is. But there are a lot of things hidden. If you listen to Ind AS, there are of course ECL models and expected credit losses, that is ECL, is to be found out item wise, either for a group, for the whole receivables or something, but that's a different thing, because if you follow Ind AS, you will have to look at receivable much more closely. But as all of us are practitioners in accounting standard, I always say that 95%, 96% will do AS only, not Ind AS. In that case, what we should know about receivables to be displayed or given in the schedule 3. One is undisputed and disputed trade receivables are to be segregated. So again, what is dispute will come to. So disputed and undisputed, disputed we already see. What is dispute? I have already told you the same definition can be used. That it has a evidence of dispute. The undisputed, disputed to be segregated. Considered good and considered doubtful to be segregated. We are doing this. And considered doubtful, obviously provision has to be there. If there is no provision and amount is material, you will go for saying that in your report, either qualify your report or say not to include you, depending on the importance. For a trader, undisputed can be if it is very high, it can be material. For a manufacturer, the small undisputed may not be material, but provisions will have to be made. Generally, you will have to see that. Aging is also required now of debtors, that is trade receivable. Now here in trade payable, it was less than 1 year. It is less than 6 months, because you are worried that whether you will receive it or not. You are saying less than 6 months, 6 months to 1 year, 1 to 2, 2 to 3 years, more than 3 years, total should match. Now, how to see what is the aging? Either from the transaction date, or if aging will have to be done from due date. Extremely difficult for smaller clients that we handle day in, day out. Let us go by transaction date. Now, unless few of their persons to whom they supply, I found some of the MSMEs supplying only to 2 or 3 MNCs or something. There it is very important to know what is the due date, because there is an agreement in such cases. For all our small clients, there will be no agreement. They just supply and you can take a transaction date for aging. Otherwise, for them also, if they are supplying 50-60% to single client, see whether there is an agreement when they will pay. Maybe they will pay after 90 days or 180 days as a rule. So you will have to start aging accordingly. So that is one. Secondly, dispute to be properly classified. I already told you what is dispute. Now coming to this unbilled revenue or unbilled dues are to be segregated. So that is not receivable, right? Unbilled revenue. Unbilled revenue is put into the balance sheet by, say, IT companies, where milestone is not reached, but the cost is incurred, and therefore billing is not. This is also done by construction industry, where the milestone is not reached, so you cannot bill, but you have received you have made expenditure. But all the, say, S7 or wherever you see the accounting standard require you to carry forward what is receivable. So if the cost already exceeds what billing can be done, it will have to be written down to the expected realizable value before you, but it is called unbilled revenue or the dues which are not billed will be billed in subsequent period. Friends, we need aging of that as well. This type of aging, if you, I was a part of the group which made the guidance note on or technical guide on early warning signals of fraud. And one of the fraud signal is continuously increasing unbilled revenue as compared to total revenue or trade creditors, trade receivables. So if it is continuously increasing, the guidance note there, we have said that you should ask for aging. And when you know that some of the unbilled revenue is of last year, last year, still not billed, whether it will be really billed is a big question. So unbilled revenue is to be separately shown other than receivable, and aging has to be done and then considered. Now bad and doubtful debt provision has to be deducted from each of the heads, and related party disclosure is to be done in all cases. So related party for all trade receivable is to be done. Now you know there cannot be say loan to directors, but directors are shown as receivable. Then you will have to see whether it is in the normal course of business. I'll give you an example there. Now related party shows director. Now director, I have a textile say mill, and textile mill has a shop. Now that shop sells everything at 20% discount, and director also got discount, no problem. Now here, suppose everybody pays after 7 days and director also has paid after 7 days, no issue. But suppose I am a manufacturing or a dealer or a manufacturer of automobiles. Now in automobile, what is the situation? 100% advance before automobile is delivered. In case of the construction, what is 100% advance before the key is given to you. In such cases, if it is shown as receivable, means bill is raised and not realized, will be the violation of section 185. Loan to director. Loan to director is not allowed. This will be taken as advance in the nature of loan or loan itself and not trade debtors. Why I'm saying is when you put related party information in trade debtors, see that we will talk about those section 179, 180, 185, 186, 188. All those sections need to be seen that they are complied with and they do not become loans. Now coming to current and long-term trade receivable to be segregated. Now here, friends, what is current? Receivable within 12 months. What is long-term is not receivable within that date. Now coming to this contractual obligation to be taken as others. I told you that in trade receivable will segregate trade receivable and others. Trade receivable will be obviously what is for sale of goods or services. All contractual obligations like insurance claims on asset side, sale of property, amount of contracted reimbursement of expenses, interest accrued on trade receivable, amortization or discount or premium on securities. So premium or discount on securities, you put it and amortize over the life of that particular security. So such things would be others and not trade receivable. Now you have to also show secured and unsecured. We were showing a secured and unsecured there in the past, but everything is unsecured generally. But can you imagine that there can be some creditors, debtors which are secured? You may not, but you can ask at least the information whether something should come in secured debtors. Now, we agreed, we have already talked. Let's go to the next one on title deeds. Section 187 is already there in the Act, which says that property, security, and other assets purchased by the company should be in the name of the company. Section 187 was very clear. Title deeds were already there in the CARO in the past, but now it has come here to say that the company needs to give details, including properties held by related parties, where and reason why it is not held in the name of the company. Now you will say we were not looking at it. Now since management itself is saying something is not in their name, we'll have to give reason also why it is not in the name. In one of my own cases, we have said at a petrol pump, there is a company which is in logistic. Now in logistic company also has a petrol pump, but petrol pump is in the name of the director. So we have been saying in the name of director. Many of the cases we have said cars are or vehicles are in the name of the partner or a director. We have said that many times. Still claim depreciation, interest on loan, everything in the company. Shown the car in the company, shown the loan. We have paid for it to the dealers from company account, claimed everything, and income tax it is allowed. So we have been showing that. But actually it is a violation of 187. But since the asset is insignificant in value, we were not reporting in our report. Remember, in CARO, here it has to be first shown by the company. So company will say cars are not held. You can and say why reason. Can I say reason is that if I buy in the corporate name, the RTO taxes will be 4 times? No, I can't say it. So what valid reason I'll give when whole money is paid by the company? Friends, this clause is not for that, for smaller this thing. Even I'll just add first investment property and asset held for disposal also, for which title deeds need to be seen. Now, and see that it is also in the name of the company. Now, friends, this is title deeds. When you say they are not in the name of company, see the other things. First of all, let us understand what details we have to give when it is not in the name of company. One is description of the property, which is not in the name of company, gross carrying value, held in the name of the person or the organization in whose name that property is, whether it is held by promoter, director, or relatives or employees. So some of the people transfer property in employees, not to show it there. So whether it is held, and you know why it is held there? It is held there because they have reasons that there will be, they may sell it at a later date or whatever. There are reasons why they hold it. So the reason is to be given there. Then the period for which it is held in that name, then reason for not holding, and also indicate if there is a dispute. Now, what is the dispute? I'll tell you here the catch is. What is the dispute? I bought an agricultural property to be made any later on, and I want to construct a factory on that. This is suppose. Now, what is the dispute? The amount is paid fully. So many acres I bought. It is owned by 2 people, my director and his brother, relative. He sold the property, got the money, went for registration, and his brother started a dispute. It was all pre-planned. It is already pre-planned that this property will never be given to the company. They will say he had no permission. The brother will say he had no permission to sell. It was a joint property, and so many things. I mean, this is one of the examples. There can be others where disputes are created. So it is also saying that is not in the name. So you are saying, otherwise it looks innocuous. There is a dispute in the court. Once the dispute is settled, property will come to company. It looks very simple. It is not. This property will never come to company because it is not designed to come to company. My original design itself is fraud. So you can see this. Now coming to this, one thing you should know. So these are the details to be given. Some of the time title deeds are with the bank. We'll have to ask title deeds are lost. Then guidance note said FIR is to be seen, etc. That's okay. These are the details. Now, first of all, genuineness of title deeds is not to be seen. The guidance note says management is responsible for legal determination of validity of the title deeds. So there is no question there is no representation in Schedule 3 about the genuineness of title deeds. It is the responsibility of management that title deeds are genuine, and it is not our responsibility. We are not experts to see this is a color Xerox. We are not. So they have not asked questions. They have also not asked questions to management because it is their responsibility. They are genuine. Purpose is to find out, companies' funds are used here, but there is no corresponding benefits. Why there are no corresponding benefit? First of all, there is no control on purchase, sale, mortgage, because he may directly do it. It is in his name, and others may not know that it is beneficial owner is the company. Now, other benefits may accrue to a particular security, for example, right shares, something else which he will take away, and he will never account it here. There can be over or undervaluation. For example, in buying, there can be overvaluation, and selling, there can be undervaluation when it is in the name of some other persons. I told you dispute may not be genuine. Now here, therefore, another thing is you give it for buying a property which is never transferred, and that money is diverted. So actually, on the face of it, it sees as if it is a capital asset transaction, but it is not. Now, in case of diversion, of course, several things can be seen like this. So this title dates you have to be very cautious. Many of us tell our articles to look at it. No, some of the things have to be done by chartered accountant. This is one item I sincerely request you to see yourself. And this disputes part and why it is not, the reason, everything you have to see and comment. Once and granted. Granted, we have several questions on this. Now, there are several sections which are there. I will see that. First is what is covered in loans advance and granted is one is capital advance. Capital advance is also covered in loans advance and granted whenever you are giving comments on that or in the schedule 3. Related parties, loans given to related parties are also covered, and loan to others, if it is other specify nature. So this is how the format is given in the schedule 3 itself. Now, loans and advances due from related parties means it is from promoter, director, KMP and others. It is given in the schedule 3, the format to be used, aggregate. And for each of these loan from relative and other than relatives means promoters, directors, KMP and others for related parties, doubtful in each of the categories to be shown separately. It is very obvious that others being doubtful and the KMPs, etc. being doubtful, then there is a doubt on the management, itself as how it can be doubtful, such a loan. So that is also to be shown. Now, AS 18 and section 186 subsection 4 is to be seen. Now, AS 18, AS 18, all of you know that there are, what are the disclosures as per AS 18? AS 18 disclosure is first is the parties, which are related parties, list out. Number 2 is transactions with related parties, and type of transactions are also listed in AS 18. And there is an aggregation of that in headwise, etc. Then there is a balance to be mentioned, balance for all these transactions, final balance of loans, advances, and other things are also given. One of them is loans and advances. And you have to give the important details for all transactions which are more than 10% of a group. So suppose there is a lease with related parties, then total lease expense is 10 crores. If any single lease is above 1 crore, maybe with related party or not with related party, whole details have to be given as per AS 18. Now this is AS 18 where all loans advances also are covered there. So I said AS 18 also requires us to give. The last part I said we miss. Many of the time what comes in FRRB, Financial Reporting Review Board, where I was as a chairman, we see the balance sheet of listed companies where more than 10% is not revealed in detail of various items which are of the related party. But we miss that part of AS 18, which says 10% is a threshold, above which itemized, type-wise, you have to give the details about 10% in each type. Now, 186.4. Now, what is 186? 186 talks of loans and investment by companies. And 186 subsection 4 talks of saying the company shall disclose the full particulars of loan given, investment made or guarantee given or security provided, and the purpose for which this loan or guarantee or security is proposed to be utilized by the recipient of a loan or guarantee or security. The second part we missed, which is a part of section 186 in company law, subsection 4, which talks of the purpose for which this loan is given. That means if that is also a public listed company, or that is, you can see the balance sheet, whether it is used, whether it is given, say, for setting a factory by subsidiary, whether factory is there. I mean, it is possible to see the trail because 186 subsection 4 already required us to see that. We are not looking at that. This is the guidance note is highlighting that we need to go for that. Then subsection actually 2 and 3 of 186 talk about loans, etc., where the limit that more than 60% of the amount exceeds of the loan given exceeds the share capital and share premium and free reserve, or exceeds 100% of free reserves and share premium. Then you need the permission of the special resolution of the in the general body, and also of course the permissions from the financial institutions, banks, etc., when the limit is exceeded, especially when there is a default in repayment of loans. Now, 186 subsection 5 also talks of no investment shall be made or loan will be given unless it is consented by all directors present in the meeting. If you are writing the minutes of private limited, remember you have to write if the loan is given, every loan, not above 60% and 100% limits I told you, require permission of all directors present in the meeting, except obviously director who is interested in that. But in private limited, even that is allowed. But in any case, when you write a minutes, write properly that all directors need to do that. 186 subsection 8 says no loan can be granted if default in repayment of deposit. 186 subsection 7 talks of interest to be charged in not lower than government security, prevailing yield on government security. And advance in excess of secured and unsecured advances need to be given separately by us here. So in total advances, loans advances repayable on demand and without specifying terms or period of repayment in case of related parties need to be separated. Now friends, this is a issue. Advance loans or advance repayable on demand or without specifying terms and condition given to related party is doubtful, in a sense that why a party is not even ready to commit interest, commit repayment period, nothing. So this is a very important information for auditor. Now coming to this particular advances in the nature of loan are also covered in this particular clause. What is advance in the nature of loan? And advances in the nature of loan need to be added and commented upon or segregated and shown. So institute tried to define what is advance in the nature of loan. Advances far in excess of value of the order. So value of the order suppose is 1 crore and advance is 3 crore. Far in excess of value of the order is advance in the nature of loan. And second is advance for a period which is far in excess of industry practice. So say I told you automobile industry will require advance, but advance for how many days? 3 days. I pay and immediately get a car. So advance given for 1 year to give me the car whenever it comes in the market. I want red only and I know red will never be made in the factory of that particular, this color is not available. So I'll give advance 1 year. So unless, that. So far in excess of the period in normal trade practice will be treated as advance in the nature of loan. So all these things I hope you will remember while doing this. Next is about the securities of current asset against the borrowings. Here, securities of current asset against borrowing. This is new clause. Actually, here if you see, audit, we knew that 100% of the stock statement, nearly 100% from small borrower is fake. We knew it very well. We signed those balance sheets on the other side also. The parties used to give us the sum figure, put it there. There are very hilarious things about this that I asked in the bank audit that where is the stock of 6 crore? You know, stock is throughout 6 crore, in balance sheet 3 crore, again 6 crore in April. And there are no purchases of 3 crore in April to add it, make it to 6 crore again back. March statements are never given. March statements are never given to the, so that it is not comparable. So I asked how the, first of all, 3 crore became 6 crore. He said, no, it is already 6 crore only in my premises. Then why it is shown as 3 crore? बोला पहले 6 करोड़ था, बाद में क्या किया, ऑडिटर बोला बहुत टैक्स भरना पड़ेगा, तो 5.5 करोड़ किया बैलेंस शीट में, फिर 4 करोड़ किया, अभी 3 करोड़ पे आए. I said if you do that, sometime we'll go to minus figure in stock, in books. He said, आके देखो ना, insurance भी क्या है? Insurance is another way of looking whether stock is really there. So he said, आके देखो ना, physically 6 करोड़ का ये हमारा चार्टर्ड अकाउंटेंट कुछ भी लिखता है उधर, मैं क्या करूँ? है stock. उसी के लिए है ये क्या चल रहा है वहां पर in true sense, whether bank is secured or not. It is on that. Now, securities of current asset. First of all, we are talking of securities of current asset only. I am not talking of a loan which is against property and it is as OD. OD against property is not covered here. Loan as a security of current asset only is covered. So no comment on if the loan is against property as OD. There are banks which are giving this. Now, quarterly returns are to be seen. Quarterly is important. We file returns every month, but end of the quarter, we file, say, stock statement, book debt statement with aging, then CMA report, that is credit monitoring arrangement recovery reports. And what the Schedule 3 requires is that if the stock is not reconciled with the book, give the reconciliation. Give the in the balance sheet notes. Now the problem is threefold. One is stock is never given on the last date. Many times companies give it on 27th, 28th, next second something, not on the last date. For obvious reason that they never wanted to tally. Now reconciliation will be required with the books on the day of the statement. Even if I say 27, the day of the statement, I will have to reconcile. And I will have to give a reason for variances. Now here, first of all, this is to be done only for quarterly statements, not a monthly statement. A monthly statement you can give. Please remember, quarterly statements are right. We had told our clients in 20 itself that now it is coming. Now 21 it didn't come. 22 at least every quarter. Now, recently I was asked to certify a particular stock and book debt statement, which was not there. They wanted enhancement for the first time in MSAB, and they said that then get it certified. I realized that the stock statement being given, we are auditors, we have never seen that. Stock statement being given is at market value. All stocks are given at market value to the bank, not at cost or market value, whichever is less, which is the accounting policy. So we qualified while writing that this doesn't match with the books, even though that was not required to be done in that certificate. He said, okay, you write whatever, I'll still get enhancement. Now he wanted to have the aging. Now aging which he had given to bank was not appropriate. So we adjusted aging also, less than 90 days, less than 180 days, whatever he wanted, 60 days. And we corrected that record and gave. But this is quarterly returns to be matched. Working capital sanction includes funded and non-funded advance. So both have to be considered that they have been properly represented in details with and all are recorded properly in the accounts. So non-funded advances. So material discrepancies are to be given with reasons and reconciliation. Now material discrepancy is a word institute as well. Actually material discrepancy means you have to decide really not very small differences, but you'll have to see which are the differences you like to give. Now, borrowings on security of current assets of other entities in the same group are to be covered. This you will miss. I also missed it in one of my clients once. They got a loan on FD of a related party. The same owner had two companies. One company was IT company and was having free income, like, no taxes. It was 10B company. So it was having free income. That was having huge FDs in the bank. That was those FDs were used as a security for other concern, Indian concern, which needed finance, working capital finance. Now this kind of, borrowing of a current asset of other entities in the same group, which is called security. Now there was a lot of discussion. As I say, I was part of all these groups, that how I will know about the current assets of that party, whether it reconciles with their books. The problem is now what is to be reconciled? The information is given by that other company. I have got a loan in this company. Now how I'll comment? Either I have to say no information is available, no information is available. All I have to go and see the information. Actually, I am not a holding company auditor, which can go in any subsidiary and see it. I may be just, there are two companies which are under same management. I have no authority, but for this clause, this is added by the institute and caution to us that there can be such kind of loans. So I'm just saying that this needs to be seen. Struck off companies and say where are now hundreds of companies have been struck off by the registrar. Transaction under section 248 or 560 under the old act come under this. Section 248 talks of removal of name by the registrar. And there are conditions when the name is removed. We have to actually see for defunct companies when we sign on the last day, 29th, we decide कि अभी करना पड़ेगा, कुछ है ही नहीं, बैलेंस शीट में कुछ है ही नहीं, वही रिपीट करना है, सिर्फ बैंक चार्जेस आया होगा, नॉन ऑपरेटिव का वो डालना है P&L, बाकी कुछ है ही नहीं, फटाफट करो. ऐसा नहीं है, it can be struck off company and when you go to upload you know कि है ही नहीं कंपनी, तो अपलोड ही नहीं हो रहा है साइट पे क्योंकि वो है ही नहीं कंपनी. So struck off company relations will have to be given as a struck off company relations. It cannot be said just put a item, of various investment in such companies are shown. This has to be specifically shown. So when there is a defunct company in the group and you have transactions or you have something there, you should know that there is now Schedule 3 requires you to segregate that information. That is what I'm aiming you at that and while looking. Now here, when the removal by registrar will happen, when you fail to commence business within 1 year of the incorporation, he may do it. I'm not saying he has done it. You will have to see with it. Second is not carrying on business for 2 preceding year and not applied also for that company to be dormant company. Third is the subscription to memorandum has not been received within 180 days and no information is given to the registrar. And company not carrying on business or occupation and physical verification is done and found that company is not working. In such cases, he can do it. Of course, 75% of shareholders also can go to the registrar and say you strike it off. But remember, all liabilities and obligation of the directors and the company are intact in spite of its being struck off from the list. That doesn't affect. The Act itself says that Section 248 itself says that all liabilities will continue irrespective of its being struck off. So what is asked here about these companies? Investment in securities. Securities will be shares, debentures, whatever. Receivables with that struck off company. Payables with the struck off company. Shares and other balances to be disclosed. Now, relationship with struck off company means whether it is your subsidiary, not your subsidiary, it is your associate, what is your relation is to be disclosed. And that related party will be in section 2, subsection 76 is the definition of related parties, not relatives, related parties. Now related parties are given. See that and give all your relations are to be stated in section 2, subsection 76. Reason for such transactions. Friend, they say that if the company is struck off, you will have a problem in actually going to court of why you are having dealing with such company and why you are having in the past also. So give reason for transactions along with provision or right of required. Now this is audit point, but I have added it here since I will not be taking it there. Now here saying this, that particularly reason why we are continuing or why we had such transaction. Now this struck off company can be such that I needed to support for some reason and I have debt. But remember that that this has an implication in a write-off in P&L. Now, when you find such a transaction company struck off means company has no asset liabilities. Otherwise, it will not be struck off. Now, if it is struck off finally, then how you are going to recover your investment in equity, your debt? So this is an implication when, this is a transparency we are talking about. When you segregate this information from other information, immediately management have to reply and auditor has to consider. This is how Schedule 3 can be linked with CARO from time to time, right? Transactions settled, reversed or squared off during the year are also to be reported. Charge registration of charges. Now this is chapter 6. You are aware section 77 to section 87 of Companies Act 2013 talk of registration of charges. Now they say that section 77 talks of 30 days required, allowed to you for registration, then another 60 days and another 60 days maximum allowed. Registration. Section 82 talks of satisfaction of charges in 30 days can be extended by 300 days. You have to see what is the number of days delay and in months and days and reason for delay is to be mentioned. Something, we have an annexure B to the guidance note of division 1. Now, Annexure B explains numerators and denominators for all 11 ratios that are required to be given. I have listed all the ratios that are here. These are 11 ratios which need to be given. Now, these ratios have to be given also for the past year. I told you problem is comparative. Now I have to calculate. Not only that, if you really see about these ratios, more than 25% change over the year need to be reasoned out. Why the ratio is increase or decrease? I told you current ratio being better. Why it is better? Because trade receivables are higher. Actually, there is nothing received, no liquidity, but change more than 25%. Item considered as part of numerator and denominator need to be explained and linked to the items in balance sheet and P&L. They need to match, and you have to say which one you are taking and why, how you are taking. Consistency over the periods has to be there, and any change in numerator and denominator need to be properly explained. And ratios presented anywhere else in the report, either board report or anywhere else in the schedule 3 must match with these figures, which are given here, if at all the same ratio. You will find that EPS is to be given at the end of P&L is not here because it's already there. You see, they have not added it here. So, but wherever it is shown, some other ratios you want to show should match to this particular. So ratios, friends, if you have forgotten, I think I did CA 40 years back, 30 years back. I think Annexure B will help us to find out what is numerator and denominator. I tried to go through the last 2 ratios. I still could not understand how, because there is so much mathematics in that. So I proposed to send it to Yagnesh to solve it for all my companies, giving professional fees. Calculate these 2 ratios and give me how they estimate as per the guidance note. I don't know. There's such a complicated mathematics shown there. P, Q, R, this, that. Investment. That's very complicated. It's more of a statistic. So it's very complicated to calculate. Now, next is, of course, denominator में क्या है, and you have to link. So better that you give a ratio and write on the right hand side ना कि उसका numerator में क्या है, denominator का ऐसे हर एक ratio का लिखना पड़ेगा. Variance reason means you should find out first variance. There will be reason. There will be reason available. I am not saying no reason is available. Please, when you sign the balance sheet, we are signing this na. So see that reason is appropriate. That is what I am saying. Because reason cannot be such. I told you na why car is not held in the name of because aisa reason nahi chalega na. So we have to find out what is the reason and write it appropriately that it doesn't affect us finally. You know, just look at it. That reason is right. And if the reason is wrong, suppose for whatever reason, now you say that last year you made a mistake or numerator was wrong, whatever. I mean, we corrected that this year and that's why this is mismatch. If you go by the same numerator and denominator, probably the ratio will not show so much, something like that. So you can explain. Utilization of borrowed funds and share premium. Friends, here, if you see the utilization of, and this covers the transaction. Actually, this particular provision is for pass-through entries. You know, there is some other ultimate beneficiary, and you are trying to see that the transactions are routed by either you through intermediaries or somebody else is routing his transaction through you, where ultimate beneficiary is not known. That is why the whole provision has come. This covers transactions which don't take place directly between company and the ultimate beneficiary, but are camouflaged by including a pass-through entity in order to hide the ultimate beneficiary. Is the real reason why this has come. The pass-through entity acts on the instructions of the company for channelizing the funds to the ultimate beneficiary as identified by the company. And that is why, to reveal that, this provision is given. There is an issue here because there can be several intermediary companies. You may not know who is the finally ultimate beneficiary, who is telling whom to transfer for what, etc. But all inbound and outbound investments are also covered for means both type of fundings, both type of funding of transactions is covered. Now, this covers understanding that such funds would be lent or invested directly or indirectly other entities. Same for when you receive the funds. Disclose the date and amount of fund advance and loaned or invested in intermediaries is the requirement. Coming to this, the date and amount of loan or investment or guarantee security or in behalf of ultimate beneficiary. Compliance with FEMA provision if such provisions apply, and prevention of money laundering also need to be seen. I don't know how auditor is going to look at money laundering in this, but it is a onerous responsibility on us that when your pass-through transaction is revealed by the company. Now problem is, otherwise the simple thing is, if I find a money received and gone out, it may not be on the same date. Remember, it may not be contra transactions, but it can be transaction. We had a company where they had sent something from Gulf and it went to other company after 3-4 months. It's not necessary that it will go in the same month. So you have to finally see the contract, and this was debited and credited to same account. Remember, to make it zero. What is received, remember the risk here. Risk is that it can be debited, credited to same account. This is a pass-through. I'm a pass-through entity. So what will happen? They will debit and credit and make it nil. What kind of transaction where ultimate beneficiary is different, or I want ultimate beneficiary different? I gave it to A. A is supposed to give it to B and then to C. I have to reveal that. And in such cases, both the things I will have to say. I have received something and paid against that. I have received and paid. I have the other way around, that somebody else paid me to give it to someone else, etc. But other way also, I have to see that these kind of transactions, once they are revealed, not only the FEMA provisions or prevention of money laundering are there. Now, this kind of funding which is done, why it is done through me? I knew of a case where they wanted to do it because they could not have paid directly with that company under FEMA. So they paid me because I was a subsidiary and I was asked to pay to other company. These kind of things are done. You will be surprised in some of the transaction relating to services. Services cannot be paid, or there are issues in TDS, there are issues in withholding taxes internationally. So these kind of amounts are routed. Here you are talking of borrowed funds only, actually, but I'm cautioning you that these are not borrowed funds. These are services payments which are routed, or some other payments which are routed can also come, even though it doesn't come under this clause. As an auditor, I'm cautioning you. I've seen this in actual audits happening and amount being made nil in the balance sheet and in the ledgers. So it doesn't show on two sides that I have received and paid, because they say नहीं ये मांगने वाला नहीं मुझसे, जो देने वाला है ना वो मांगने वाला नहीं, तो liability दिखाने का क्या problem? But it had received from foreign country and I have paid to someone in India. I said it is two sides. No? I should show on two sides. बोला नहीं ये मांगने वाला नहीं और ये देने वाला नहीं. तो ये साथ में लगा देते हैं, खत्म हो गया काम. ये क्या अपना ये type of accounting तो सब जगह चलेगा. Direct and indirect lending is also covered. Complete details of intermediary are required in this case that you should know. And what is the detail? What are the details required in this case is restrict the disclosure to pass-through transaction during current year only. If you find such pass-through transactions of the last year, this year, since you are looking at it for the first time, the guidance note says give it only for the current year. Complete details are required. Name, registered address, government identification number, relation with the company when this with whom such transactions are there. The understanding, what is understanding? And see, finally, there is an understanding that this money will go somewhere else, or this is received for ultimate beneficiary somebody else. Understanding means appropriate evidence in the form of various things. You can look at the board resolutions, investment agreement, share purchase agreement, term sheets, etc., to see this. Benami properties acquired under Benami Transaction Prohibition Act 88 is what it says. Now the act has been renamed in 16 as Prohibition of Benami Property Transaction Act 88. Now, or holding of any Benami property are to be given. Now, what is the details to be given? First is details include, first is name of that particular property, then the nature of the transaction, year of acquisition, the amount, that is acquisition cost, the details of beneficiary, that is name and address and government number of that party, whether accounted in the books, and if accounted in the books, any Benami transaction for which notice is received, they say it is in your name and it's not accounted in my books. That is also to be shown now. If the notice is received that this is in your name, but I don't find or the company doesn't find it in the books there also, and it is not accounted in the book, then why it is not accounted in the book? Company can say, I'm not, I don't know. You know, under Benami property, the person in whose name he can deny, saying, "Mujhe nahi malum, ye kaise mere naam pe hai." So if that is the explanation, you will have to say that that is the explanation. That is why it is not in the books of account. So why it is, whether it is in the books of account, if it is there, where it is, and if it is not there, why it is not there, is to be explained. Nature of proceedings. So whether it is attachment, adjudication, confiscation by initiating officer, or the date of show cause notice, etc., will have to be given. Current status will have to be given. Case of a dispute on proceeding and state the period of the dispute in case. Friends, quickly we go to willful defaulters. Friend, willful defaulter is not something which is very often our clients. But what is a willful defaulter? A willful defaulter means a person or an issuer who or which is categorized as willful defaulter by any bank or financial institution or consortium thereof in accordance with the guidelines on willful defaulter issued by RBI. The RBI Master Circular talks of willful defaulter, and when a person is a willful defaulter can be declared is a default in repayment obligation, diversion for the purposes not specified in the sanction, siphoning of funds not available even in the form of any other asset, disposal or removal of asset without knowledge of the bank. In such cases, the person can be declared as willful defaulter. Declaration up to the date of audit report has to be seen, not declaration during the year. A declaration of the earlier year and continuing default also need to be shown. Declaration and the guidance note gives a reason. It says and others, declared by others. It says there cannot be any others. No one can declare you as willful defaulter other than banks, financial institution, or maximum any government or government authority. And look at these sites just to see that. Just last one or two items before we break. Income surrender disclosed in tax assessment. Many of you are tax experts and you know that there are details of transactions which are not recorded in the book but surrendered and disclosed as income in the tax assessment, in search survey or otherwise they are declared. Now the problem is that when it is called the surrender or disclose, the guidance note gives very detailed explanation on this, but in nutshell, if it is a voluntary admission supported by return, then only it is called a voluntary disclosure. Otherwise, it will not come under this clause. Statement, if it is retracted, will not come under this clause. If the company has disputed the addition, it will not come in this clause. If it has not disputed and not filed appeal, by itself does not mean that it accepts. Because there can be buying piece, you will say 6 years, he has asked me to pay. Now the question for the auditor will be in this case is what is the asset they are saying? You have cash, you have sales which are not, expenses inflated, what the income tax is saying. And that has very major implication, but reason for non-disclosure or not recording. So when this is disclosed, accepted voluntarily, if it is finally accepted or you take it as accepted, then reason for non-disclosure in the books of account is to be stated by the company. Very difficult, very difficult. If you are saying sales are, cash is not accounted, the asset is not accounted, sales are not accounted, it's very difficult. Now, therefore, I also stated, this is an audit point, the last one, that it has implication on IFC reporting. And it requires the modification in nature, timing, and extent of audit procedure. You know what is nature, timing, extent? This wording, this phrase is used several times in auditing standards. Nature is what work you are doing, sales, purchase, cash, etc. Timing is when you are doing it, at the end of the year, during the year, after the year, whatever. And extent, that is a percentage checking. So all this needs to be changed after this kind of revelation is made. And if it is of material consequence. So suppose my sale total is 10 crore and over last 5 years, 50 crore now, I revealed another 10 crore. I'm just giving you some examples that it is material. Then why, what was stock record? I have seen, I have given IFC certificate for various controls existing, all that. And by current years, the nature, timing and extent of audit procedures would change substantially because of this. This is a serious thing for auditor if it is revealed and if it is accepted. If it is not accepted, they will have to give reason that we are not accepted this, but to buy peace we have paid, or whatever we have filed appeal, or we don't want to file appeal. But then that is very important. The last one is on cryptocurrency. Profit loss, currency, amount of currency held, then deposit or advances collected from other person for such kind of trading, etc., are to be given, because finally, now it is being taxed. So they want a separate description on this. Now coming to the last slide on this particular subject before we break and go to CARO after the break. Here the representation to MCA is being considered by ICA. When I was a CLCC chairman last year, we have prepared this representation and sent it. I have sent it to council also and discussed. One is materiality in presentation is not there. As I told you, nowhere it talks of materiality. We want it there. Then we also want exemption for presentation of comparatives. I told you that several CWIP, so many things, there are comparative ratios. If that is not given, if it is given as a transitional provision for first year, the previous information is not required. We had a webinar just 2 days back, 3 days back, where even Amarjit Chopra all supported this particular move on materiality and exemption for comparatives, etc. We need to go to MCA and see whether it can be done. So friends, thank you for the time being. We'll meet up.
And since it's a time of break, so the upstairs near the pool side. But today, since there's some marriage functions are going, so we take the first here only at the downstairs. And since the counter it is at the back side, so the people who prefer the Jain food, they will have to take the plates from there. And that non-Jain food, it is there in the nearby place. So we'll have to take the plate, and you can sit here, you can have your breakfast. So we'll have to cooperate today.